Hi, and welcome to the Down to Finance podcast by Future Finance Group. We recently hosted our first time investor seminar, bringing together experts from lending, accounting, property, planning, and more. Across the night, there were plenty of sharp insights and real-world guidance, so we're distilling some of the best moments for you here. Today's highlight is Adam Pasquill, partner at Highview Accounting. Adam broke down the essentials of tax structuring, negative gearing, capital gains, and why choosing the right ownership structure from day one can make a huge difference. Without any further ado, here's Adam.
So before I start, everyone, my name's Adam Pasquill. I'm a partner at Highview Accounting and Financial. A little bit about us. Highview Group is quite a big group. We've got about 150 employees across the whole group. We predominantly do sort of accounting, advisory, compliance, all the sort of fun stuff that we all love doing every single year. For myself, I've got about 12 years experience in the industry. My main sort of bread and butter is in sort of wealth creation, tax minimization, and ensuring structure is correct. And that's probably where a lot of this discussion in my topic is going to be about, is structuring. It's very, very, very important. Also, just in July 2025 this year, I opened my own office in Frankston, hence why I'm here today. And so that's me and my two little boys there. So a bit of a story of me. Next slide, mate. All right, so why all the hype in investment properties? The main one is tax advantages. The last 15 years, we've all watched property prices boom. I think it's pretty fair to say that. And the main reason is because of tax, in my opinion. So there's two reasons. One, negative gearing. So for people who don't know what negative gearing is, it's where your expenses exceed your income, generating a tax loss. That tax loss then reduces your taxable income, which then results in a lower tax payable or a tax refund at the end of the year. And that's what everyone sort of gets excited about. That is then increased through depreciation, which BMT will discuss with you shortly. The other side of the coin is the capital gains concessions. So when if we generate income on revenue, so we make income from our employees, we pay tax 37 cents, 32 cents in the dollar. When you sell a property, you make a capital gain, only half of that profit is taxed. And that's a huge, huge, huge tax saver. Obviously, you have to hold that property for longer than 12 months for that to work, but that's the bread and butter of what people want to do it for. Yep, next one. And the other part of it is you can invest for your benefit. So we don't always have to talk about residential property. I think everyone thinks of invest property as residential. It doesn't have to be residential. It can be commercial as well. So it can be things like factories, shop fronts, office space. It could also be a holiday home that you sort of want to have a mixed use supply with. It also could be a future retirement home that you want to lock in now, but maybe move in 10 years' time. So there are plenty of options there on the cards. So as I've reeled in before, the most important discussion is structure. So everyone's circumstances are different. I think Amy nailed on the head before, no one investor is the same. So things you need to consider, are you going for growth or are you going for income? So you're trying to supplement our income, or do we want to try and get that long-term growth and get that capital gain? Are we going for a short-term investment or a long-term investment? What is our current tax rate and our future tax rates? It's a very important consideration. How much are you willing to spend to get into this structure? And also, how flexible do you want it to be? And last, and probably most important, especially now in Victoria, is state taxes. Every state has a different implication for you. So structuring-wise, there's lots of different structures. You can buy individually, / partnership. You can buy in a company. You can buy in a discretionary trust, a unit trust, or an SMSF, which I think everyone probably hears SMSF at the moment all over the media. Next page. So I'll go through all the structures just very briefly. I'll skip over a few of them because they won't be very important. So everyone knows sort of an individual and partnership structure. So that's whether or not you own it in your own name, or if you own it sort of husband and wife is generally the usual one. The pros of that, it's very simple and easy to set up. You just go and get a finance and go and find a property and happy days. You got a property for yourself. The good thing about it is you can use those tax losses to reduce your taxable income, save some tax. Great. And also the capital gains concessions are there. The one con that a lot of people really, really don't realize is negative gearing is great in the short term. Long term, it actually starts to hurt you. Short term, your income is going to be, a lot lower than your expenses. Over time, your income's going to go up, your expenses are going to go down. You start having profit. Guess what? Taxman likes it then. And also, it's not very flexible. The next option is a company. Now, I'm probably going to skip straight over this one pretty quickly because I do not ever really recommend investing in a company. unless you're in the game of property development. It's just not an effective structure, tax-wise, not ideal. So I'll skip over that one. The next one is a discretionary trust, or also known as a family trust for most people. So a family trust is very good because it's a very flexible structure. So 1 year you can distribute income and growth to one party, and the next year you can distribute it to somebody else depending on who has what income in their names for that year. So it's very, very good in that you can flexibly distribute between mum and dad depending on how much they earn that year. You can bring kids into it, subject to discretionary requirements. You can bring a lot of parties involved into it. There is a bit of a con. It's a bit more expensive to get into this structure, and also your negative gearing benefits aren't very beneficial in the short term because they actually get stuck in that structure, so you can't offset it against your personal income. So that's probably the one big loss in that respect. Next is a unit trust. A unit trust is relatively similar to a family trust, except you have fixed entitlements rather than that sort of flexible entitlement that I mentioned before. Very, very useful for multiple parties investing in one asset. You know, if you had two business owners and they wanted to buy a factory, for example, they might want to know they own a certain half of that property, but they want to have that ownership, together. So unit trust is very good in that respect. If you have multiple parties into it, it's very good because you can pass ownership around as and when needed. Again, it can be very, very complex unit trusts. So it has a lot of high entry costs and operating costs, especially from compliance point of views. And also, again, those tax losses, those negative gearing benefits we mentioned before, they're no good in this sort of structure. Last, but definitely not least, is self-managed super funds. It's got a lot of benefits and it's probably a very, very good topic of discussion. The reason why self-managed super funds are so good is you can pull your industry or your retail funds that you've got invested over time, you can pull that funds together, husband, wife, whoever you wanted to do, pull that and go buy property. Now, the beauty of that, tax rates in the super fund are amazing. Your revenue, so your rental income, only taxed at 15% or 0% if you get into retirement. If you make a capital growth, if you hold that property for less than 12 months, you tax at 15%. Hold it for longer than 12 months, only tax at 10%. Hold it into your retirement, all that capital growth is tax-free. Now, I will put an asterisk there. There are some limitations to that, but generally speaking, an amazing tax haven. One of the other big pros is it's giving you access to cash flow that isn't otherwise available. So Amy mentioned before how it's hard to get that deposit. Now, that deposit might be sitting in your super. So you can potentially pull your funds, put it into a self-managed super fund, and there's your deposit to pay for a property. And then that super fund can also lend and be treated separately from you individually. So it's a very, very good structure depending on your circumstances. A couple of cons, it's very complex. You need a very good financial planner. That's what Index Wealth is here for today. It's very costly to get into, and it's also very regulated. And as Amy would probably attest to, there's not many lenders in this space, so it's quite a niche space. Yep. Couple of case studies just to wrap it all up, to hopefully give a bit of run home. So Ronnie is a successful musician. He earns about $200,000 a year. So he's single and he's focusing on building his wealth. So he's come to us to go, what structure do I buy this in? Now, I'll reiterate a few things. His priorities, he wants to minimize his tax, as everyone does, and he also wants to invest for his future. That's his priority. That's all he really wants to do right now. So what we would suggest for him is he would go into an individual ownership structure. Right now, his income is $200,000 a year. So he pays 47 cents in the dollar for every dollar he earns after that point in time. So if we can get into a negative geared property, ramp it up with a bit of depreciation, we can save a lot of tax for this guy. So next page. So a bit of a numbers thing for those that like numbers like myself, because I'm a nerd. So we got rental income, 24 grand a year. Then we got rental expenses. So any expenses that he's incurring to maintain that property available for rent. So things like council rates, water rates, insurance, land tax, repairs and maintenance, depreciation, all those items come in to reduce that income. So we got 10 grand worth of rental expenses. We got $20,000 of loan repayments for the year, of which $14,000 of that is interest on the loan. And then we also have depreciation, which BMT will help us with, to get $12,000 worth of extra deductions. So we look at this on 3 layers. So the cash flow side of things, we're generating rental income of 24 grand a year. We're spending $10,000 a year in rental expenses, and we're paying $20,000 in loan repayments. So for the whole entire year, that's cost us $6,000 to maintain this property. Right? From a taxing point of view, we've got our rental income. We can then deduct the rental expenses. We can deduct the interest on the loan, and we can deduct the depreciation that we're available as well, because that property depreciates in value. So we're making about a $12,000 tax loss based on all that there. Tax benefit for him, his tax rate's 47%. He gets a $5,640 tax refund or reduction in his tax. So it's cost him $6,000. He gets a $5,640 tax refund. It's cost him $360 for the whole entire year to maintain his property. And that's the benefit of it. Now, I will preface it with saying we need to make capital growth. Otherwise, it doesn't make any sense. You may as well stand at the front throwing $100 notes on the floor. But if you're making capital growth, this is a great investment strategy for this person. Just to give more of a complex side of things, Barry and Fred, they own and operate a successful plumbing supply store. They're both unrelated, so they have, they've got different wives and children. They run different lives altogether, and they're currently leasing the premises that's become available to purchase. Okay, so their priorities: they want fixed ownership and control. So they want to each have their own entitlement to this factory or this location. They want asset protection because they run a business that has risk, and they want tax flexibility because everyone wants tax flexibility. Let's be honest. So the recommended structure for them is something like a unit trust. So unit trust for them gives them that fixed ownership because they know that they're 50-50 owners of this factory. The asset protection comes because there's a company attached to it, so it separates themselves from their other business, which is great. And then the tax flexibility we can also do if we make a nice complex structure and give them the right unit holders of their entity. I'll go into that later if you want to talk about it further. So basically key takeaways from my topic is structure matters. It's literally the most important discussion, I think, in any investment decision. So make sure you choose a structure that aligns with your goals, your tax position, and your borrowing capacity. And as Amy said before, seek advice early. Like, even if you haven't got the deposit ready, seek advice early. This is my plan of attack. How do I get there? And what does it look like for me? And that's it. I wrote questions, but I think I'm going to do questions at the end, I'm assuming. So don't worry about the question slide. Thanks, everyone. Hope that was good.
Thanks for joining us on the Down to Finance podcast. If you enjoyed this episode, follow along on socials and hit subscribe so you're always up to date. Just remember, nothing you hear here is personal advice. Everyone's circumstances are different, so have a chat with your broker or financial advisor before making any moves. And if you're unsure where to start, Future Finance Group is here to help you map out the right path. Catch you on the next episode. Thanks so much for listening.